All right, good afternoon, fellow CFA Society Detroit members. Vince Vitale, your current president. Got a great webinar today for you. General housekeeping up front here. Please submit questions by scrolling towards the bottom and using the chat function or Q&A. We'll answer those at the end. Few upcoming events that we want to recognize is the auto show lunch next Thursday, I believe. At the Chinoa Hotel. I'm sorry, that was actually in 2 weeks at the Chinoa Hotel. Please sign up for that. That's in person. It should be a great event. We will have a commercial real estate presented by Black Creek on October 6th. And don't forget our in-person forecast lunch this year. We'll be back in person. That's on November 5th. We'll be down at the Motor City Casino soundboard. So be on the lookout for the invitation for that. With that, I'd like to introduce Michael Shee from ABR. He will do the introduction for Taylor.
Hi, good afternoon, everyone. Thanks so much for joining. My name is Michael Shee. I am the Director of Sales at ABR Dynamic Funds. So I cover the entire Michigan area. If there are any questions that we have not addressed during this Zoom, please feel free to email me or give me a call. I'm sure that information will be sent out to you guys. Now, I'm here to introduce the founder and CEO of ABR Dynamic Funds. His name is Taylor Lukof. He has about 15 years of investment experience, and his entire career he's been trading vol and was actually the youngest member on the American Stock Exchange when he joined. And then he became partner in 2008 at a company called Toro Trading, where he co-managed equity derivative trading strategies. Love to introduce you guys to Taylor Lukof. You can take it off.
Thanks, Mike. And thank you, Vince, Michelle, Ashley, and the entire Detroit CFA Society for having us here today. My name's Taylor Lukof. I'm the CEO and founder of ABR Dynamic Funds, as Mike mentioned. And today we're going to talk about volatility. So the presentation's titled, "This Time is Not Different." So what do we mean by this time is not different? Well, people generally think they have an idea of when we're going to head into a crash or when we might be in a lengthy period of smooth sailing. And usually the high periods of volatility don't happen the way we expect, right? How many people in retrospect can say that they predicted a global pandemic and a 35% drawdown in the S&P in 4 weeks? Then during the pandemic, how many people can say that they predicted new all-time highs within a year, over 100% gain in the S&P? So we want to talk about historically how volatility has behaved, why we think that, but why volatility, at least historically, has been predictable. And then we'll give you just a brief introduction to ABR and what we do towards the end. So let's get started. We are based in New York City. The background that you are seeing behind me, hold on one second. Let me make this full screen. There we go. The background you see behind me, you actually see the Statue of Liberty over my pointer finger right here. So just to give you some context, we are in the southern tip of Manhattan, and that's Battery Park behind me. So just quickly about ABR Dynamic Funds. We were founded in 2015. We've grown quickly over the last few years. We now have over 800 million under management. We managed less than 100 million in January 2020. So we're experiencing a period of rapid growth. We'll talk more about what we do towards the end, but just to give you a little context of how we use volatility, we use it in a dynamic fashion, which is what we're going to talk about today. And the story is dynamic correlation. You see very unique return streams here in our strategy, our flagship strategy, and we'll talk about that more, like I said, at the end. So first, let's go into a background of volatility assets. What you're looking at here is a correlation table that shows long-term asset class correlation to the S&P 500. And you'll notice that most assets are actually positively correlated to equities. A lot of people use real estate as a hedge. That's actually one of the highest correlated asset classes to equities. We don't have private equity on here. A lot of people are using that. That's also highly correlated to equities. Fixed income traditionally has been something that people use for negative correlation to equities when things go bad. But as you saw in the financial crisis, and this is, we're using aggregate bonds here. And even as you saw a little bit last March, you started to get a positive correlation between fixed income and equities last March in the depths of despair. It's not to say that fixed income is bad, but I think we can all agree that many investors are concerned whether fixed income will continue to provide the negative correlation people are looking for. The only asset class that stays negatively correlated to equities all the time, and yes, there might be a 1 or 2 week period here or there where volatility and equities become a little bit correlated. We saw that at the end of August 2020, but in general, volatility is almost always negatively correlated to equities, and that negative correlation grows stronger during a crisis. So volatility assets are well suited to complement traditional portfolios. However, there's some problems. There's some good and bad attributes to volatility assets. When you look at equity volatility, one of the good things is it's negatively correlated to equity price. And that correlation we showed you is one of the strongest correlations in all of finance, right? But the bad news about equity volatility is volatility has a negative carry component. If you buy and hold volatility in a static allocation, there is a premium associated with that. We have a wonderful chart on the next page to show that. And if you try to short volatility and hold that short position in a static allocation in volatility to collect the premium, it works really, really well until it doesn't. Historically, these allocations have blown out over time. And this next chart shows some of the failures of static volatility exposures that we've seen historically. That's part of the reason why investors might be a little bit concerned when using volatility. In the top left, you're looking at the index that a very well-known ETN tracks. It's the long volatility index, not the VIX. This is investable volatility. And you'll notice exponential decay over time. And what this is this is the contango of VIX futures. People will talk about roll cost, et cetera, et cetera. We make a much more simple analogy. You're looking at a graph of insurance. And I don't care whether it's insurance on your house, your car, or your portfolio. The insurance company is rated to win over time. That's why they're in business. So if you buy and hold volatility over a long enough time period, you will lose. There is a bleed out associated with that. This became well known to investors over the past decade or so. And so static short volatility strategies became very popular. Selling insurance is a wonderful business so long as you can survive the payouts when a hurricane inevitably hits. And what you're looking at on the bottom right is a well-known index, the inverse of the long vol index. It was doing very, very well until February 5th, 2018. Some people call this date Volmageddon. It was almost 100% gain in one day for the VIX futures. These products lost billions of dollars and closed overnight. And any products that were left or reconstituted, many of them fell to a similar fate in early 2020. So what we like to say in short is, if you buy and hold volatility, you will experience a bleed out. If you sell and hold volatility, you will experience a blowout. That is the failure of static volatility exposures. And I'm sure for many of the people in the CFA Society, this is familiar. I'm not telling you anything you don't know. So here's something that you may not know. Historically, volatility has actually been highly predictable. ABR's research going back to the 1920s, and we're going to show you that over the next couple slides. 1928 is the full history, daily history of the S&P 500. But we're not alone. Yale University has it, PIMCO, Vanguard, a whole host of other institutions. It's no longer arguable whether or not volatility historically has been predictable. But that really doesn't matter because we care about the future. And no one knows what's going to happen in the future, least of all me or ABR. But I think that if investors, or if we can develop a thesis around that historical predictability of volatility, we can develop a higher probability of being successful going forward. So the research at ABR on volatility and the predictability starts and stops with human behavior. Human behavior is completely irrational. And that irrational behavior is amplified when humans are stressed, okay? We've seen wonderful examples of both ends of the spectrum on that stress for investors over the last 2 years. March 2020, we had a global pandemic. The S&P drew down about 35% in less than a month. We just mentioned that. The VIX spiked to an all-time high. And guess what? People sold. If some of you are investment advisors on that call, or even individual investors, it's very difficult not to sell when you're in the middle of that global pandemic and the market's crashing. That's fairly irrational behavior. Now, right now, we're in a state of euphoria. The market is at all-time highs. I think August, we had the most all-time highs, new all-time highs in a month, going back to the mid-90s. Many investors are flocking to equity markets, and they could be right. The market could continue going higher for years. We have no idea. But where were those investors last year during the pandemic when the market was 100% lower? You can't argue that that wouldn't have been a better time to buy equities. So these states of euphoria and panic where investors either buy high or sell low create this predictability on volatility. And we believe that you can systematically shift vol exposures to harvest alpha. Talk about what we do more at the end. And this is based on millions of years of evolution. Humans are herd animals, and our research indicates that, this is at least how it's been. Whether or not you believe that will continue is on you. Our bet is that, at least for the rest of my lifetime, humans are still going to panic and humans are still going to face states of euphoria. And, we've seen that very recently, both of these at the extremes. Now, we'll talk about what creates this predictability from a mathematical standpoint in a second, but I just want to show some examples of the panic we saw last year. This is a graph on the left from Morningstar showing different asset class flows. And as you would expect, in March 2020, you saw massive outflows at the lows, and now you're seeing massive inflows at the highs. The bottom chart shows corporate bond flows on a daily basis. Now look at March 2020. It began on March 2020. The market really started dropping in late February, but the biggest outflows coincided with the largest drop in the market, which is not surprising in the S&P. So corporate bonds were outflowing, people were selling everything, and then they were still selling heading into April, and then things started to look rosy and they started buying it back. But this is pretty consistent behavior that we've seen across almost all volatility spikes going back, to the beginning of the S&P. And I don't think that will change. Maybe we're in a state of euphoria right now. Okay, so this is the other side of that graph. Inflows to global equities. Data from Bank of America. This is quite impressive. More money has flowed into equities globally in the 6 months between November 2020 and April 2021 than the 12 years from the end of the financial crisis, or the lows of the financial crisis, to 2020. And, as of mid-July, if equity funds continued having inflows at the same pace, 2021 would be bigger than the past 2 decades combined. Maybe that smells a little bit like euphoria. Problem is, you don't want to be the person that is selling at those lows. Crashes are quite rare, but if you sold at the bottom of these crashes, it was pretty painful. COVID's not on here, but that was a very short drawdown from a max drawdown to drawing back up. That was pretty quick. In the global financial crisis, that was also pretty quick, maybe 2 years or 2.5 years. Same with what happened in following the tech bubble burst. Now, some of these were much longer, the 70s, Great Depression, et cetera, but selling down here at the lows is pretty painful over time. So why do we think volatility is predictable? We talked about human behavior. Here we're going to have a discussion about what's behind that human behavior. How can we quantify this effect? The reason for predictability and volatility is that volatility possesses a very unique property called autocorrelation. If you've taken and passed all 3 levels of the CFA, At some point, you came across autocorrelation. And what that means is something self-correlates, right? And volatility at the extremes, either when it's very high or very low, tends to self-correlate. Volatility also possesses the property of mean reversion, right? The VIX averages 20, the VIX goes to 40, eventually it's going to be below 20. The VIX goes to 10, eventually it's going to be above 20. So what most people do with volatility is they run mean reversion strategies. They buy volatility when it's low, and they sell volatility when it's high, and they employ something called GARCH modeling. And it's not that it doesn't really work, but it doesn't really work that well. If you bought volatility in a mean reverting strategy for the 10 years leading up to March 2020, there's a very good chance you didn't make enough money in March 2020 to cover your nut. And even if you did, you had to get out of it very quickly before volatility came back down in April. Conversely, if you started shorting volatility in February 2020 when the VIX first hit 30, what did you do in early March when the VIX hit 40? Did you sell more? And then it went to 50. Did you sell more? And then it went 60, 70, 80 in about 2 weeks. Next thing you know, you're out of business. So we feel that by using autocorrelation, investors can use a trend following, momentum-based approach to volatility. Before we get into how we do that, we're going to show you the empirical evidence of autocorrelation of vol. So we have a wonderful quote here by Mandelbrot. Mandelbrot did a lot of research on fractals. And within that research, he wrote extensively about autocorrelation. Now, this is over 60 years ago. Well, right around 60 years ago, I should say. Yet still, it fascinates us how so many people are not employing autocorrelation. So what we did is we looked at the full history of the S&P 500 going back to 1928 on a daily basis. We then calculated realized volatility, daily realized volatility. It's very simple. It's just standard deviation of return. And what we realized is that volatility moved in the same direction on consecutive days 55% of the time. So what does this mean to the layperson? Well, this means, well, first of all, to the CFA Society, this means that if you told me which way volatility moved today, I had a better than 50-50 shot of predicting which way it would move tomorrow. To the layperson, this is the same as coming to work every day for over 90 years and flipping a coin and being right 55% of the time. That is an incredible level of predictability over a very large statistically significant sample size, 90 years of daily trading data. We noticed something else interesting. Since 2006, when VIX Futures launched, autocorrelation has become even stronger. Why has autocorrelation become even stronger? And I noticed there's a question that relates to high-frequency trading algorithms. We'll talk at some point about this, but this kind of talks about algorithmic trading or systematic trading. We don't have a proof yet for this, but we do have a thesis we're working on. Is it possible that this is related to passive indexing and passive asset management? You think about the growth of passive investing in the last 15 to 20 years. It's been absolutely massive. Perhaps that's the reason why. But the short story is autocorrelation has been around for over 90 years, and it's only gotten stronger recently. Now, we don't look at which way volatility moved yesterday or today. That's not part of our algorithm. All we're doing here is trying to show you proof of the predictability historically of volatility, which we attribute to autocorrelation. So how should you use this? Most investors, again, use that mean reversion strategy in vol. They buy vol when it's low, they sell vol when it's high, because they know that the VIX will eventually mean revert. The trouble is you cannot buy the VIX index. You're buying put options. You're buying VIX futures. You're buying ETPs related to volatility. So the VIX can sit at 15 for a year and you could lose a lot of money due to that insurance premium, due to that volatility risk premium we talked about. So here we're looking at what we think people should be looking at, which is this buy high, sell low process with vol, which is very counterintuitive. So we looked at the VIX index, and since VIX futures launched, the VIX spends, over 90% of its time below 30, which makes a lot of sense. The problem is if you own the rolling 30-day average of the front 2-month VIX futures, which is the SIBO VIX short-term futures index, you have a negative expected next day return. You should never invest in something with a negative expected return. Yet people are doing this every single day. What's interesting is when the VIX is over 30, which is rare, you notice that you start to see a positive expected return, right? So this is that evidence of autocorrelation. You actually want to be buying volatility as it's going higher, and you want to be selling volatility, even selling it short as it's going lower. Now, how you do this and how you manage risk is paramount. We believe it should be 100% systematic. You cannot have a human manually intervene. Humans are susceptible to overriding a system at the worst possible time. Maybe it's in a global pandemic. Maybe it's when we have a unprecedented election with results that, people weren't sure who was going to be the next president the night of the election. That's never happened before. There's a lot of vol managers that may have gone off script, or even equity managers, fixed income managers in those scenarios. And usually that ends in tears. Now, in our models, we don't look at, is the VIX over or under 30? This is a generalization for a presentation. So now we're going to talk about when you're buying and selling volatility in a systematic way. If you buy volatility every time the VIX goes over 30, or every time the VIX looks like it's trending higher, you're going to have a lot of false positives. So here we're going to talk first about false positives and false negatives. Again, you'll probably remember some of this from your CFA days. In disease detection, if you are detecting a disease, you have true positives and true negatives. A true positive is you test somebody for disease, it comes back positive, and they actually have the disease, and you can perform corrective action. That's a good thing. A true negative is you test them for disease, they don't have the disease, and you don't treat them. That's probably the best situation. What you also can have are false positives, where you think the patient has the disease, they undergo treatment for the disease, and then it turns out they never had it. It's not the end of the world, but it's certainly suboptimal to have to go through all of that. But what you really cannot have is a false negative. This is when you miss the disease, you diagnose it as a negative test, and they do have the disease, and at worst case, the patient can die. So having false positives is something that we see in the medical community, particularly with maybe cancer detection. They cut off a lot more moles or lesions than they need to, and that's because you don't want to miss that one cancerous mole, right? And it's kind of okay to do that. But what you don't want to have is those false negatives where you don't cut off a lesion. This kind of applies to volatility and investing as well, right? If you buy volatility and the market crashes, great. If you don't buy volatility and the market doesn't crash, great. So true positives and true negatives, that's not a problem. A false positive, every time the VIX looks like it's trending higher and you think that due to autocorrelation, you should buy volatility, you're going to have many, many false positives. It's not the end of the world, but the cost of that insurance does create a drag. And that drag isn't catastrophic, but it can be quite expensive. And it's a reason why a lot of people have said, you know what, I'm sick and tired of these strategies. But what you can't have is a false negative where you don't see it coming, or you don't think it's coming for whatever reason, or your model doesn't, and you don't buy volatility. And then there's a major 30, 40, 50% S&P drawdown. That's a problem. So at ABR, we found ways to reduce the false positives without creating false negatives, at least historically. So let's talk about that over the next couple slides. Since the rally post-COVID, or well, I guess COVID's still going on, but post the crash of the market, since last May, we've had several false positives in the VIX, right? We saw several of those over the summer and the fall before the election. We had some in January around the meme stock phenomenon. We had some interest rate scares. But each time the VIX has kind of climbed back into the upper 20s or even the mid 30s or 40s, we have not had that follow-on crash. And what happens is people buy a ton of crash protection, crash doesn't occur, and it can be incredibly frustrating. Or they get out of equities. Okay, I made it through COVID, now I should get out of equities. And that kind of tactical fly by the seat of your pants investing is not effective. So we're going to show how ABR's models work in terms of false positives and then reduction. So here we're going to start to show you ABR's models. And what we have here is one of our strategies that focuses on long volatility only. So there is no shorting volatility. This is just purely long volatility strategy that's dynamic. What you're looking at is the VIX since the beginning of 2006, which is the full daily history of the VIX index. See 2008, the VIX hit around 80. 2020, the VIX hit around 80. Actually, I want to point something out here. A lot of people think that the VIX is upper bound by 80 because it didn't really peak higher than 80 either one of these events. And that is absolutely false. Some people have back calculated a VIX to 87 and think that it would have been over 160. And if you think back to last March 15th, the market didn't have to rally, right? This could have gotten worse. So don't think that the VIX is upper bound by 80. I'm not trying to sell fear. I'm just trying to explain that it's coincidental. The bottom chart is the monthly correlation, the 1 month rolling correlation of our long vol strategy to the S&P 500. And you'll notice there are a lot of false positives. You see the VIX increase here, and in late 07, early 08, the model bought vol and it was wrong. Now, when the market really crashed in late 08, the model bought vol and it was really right. But you see a lot of these false positives here, where the correlation is dropping from about 1.0 or 0.9 or higher to maybe 0.5 or even negative, and there's no crisis. That's not the end of the world, but maybe there's a better way to do it. So here we introduce one of our strategies that uses 75% exposure to that long vol only we just showed you, and then 25% to a short vol strategy, right, to help mitigate those false positives. What you have here is, again, a very tight correlation over time of around 0.9 or higher to equities. But you're still getting that negative correlation or lowered correlation when you need it around these major volatility events. So you're dramatically reducing the false positives, but you're not introducing false negatives. And that's the most important part. So if I flick back and forth really quick, you see a lot of false positives, a lot less false positives. A lot of false positives, a lot less false positives. If you're just looking at the bottom of the screen. That's very powerful. How we do that and what we're doing is a discussion for another time. But we wanted to show you a little bit about the dynamic management of volatility assets, how that's based on autocorrelation of volatility, and why we believe a mean reversion strategy is inferior to a trend following momentum-based approach. I'll talk a little bit about ABR, and then we can get into some of the questions I see that have come in. So ABR's flagship strategy is what we call our 75-25 volatility strategy. What we're saying there is it's a combination of 75% of our long volatility index and 25% of our short volatility index. We have a unique relationship with Wilshire Associates. We've actually created the first index in Wilshire's history with third-party intellectual property. That was back in 2015. Everything we do is completely systematic and index-based. So we give our algorithms to an independent third party, in this case, Wilshire. They independently calculate and publish index values. And then we create investment vehicles that give those returns minus our fee. And we do this for a transparent method of strategy creation, where our clients can look at the individual strategy performance, then look at the daily calculated index from Wilshire and see a tight correlation. It removes style drift, investment sprawl, and a lot of the other things you worry about when investing in alt managers. You don't have to take our word for it. You can see on a daily basis that tight correlation. We have about a 0.99 correlation in our strategies to our indices. So this just real quick shows you some return data to kind of give a little bit of teeth to what we just showed you. All of this is live data since 17, when our short vol strategy launched. And so we have in-sample data from Wilshire from 2006 to 2017, and then out-sample data from Wilshire, which is the actual performance. Purely out-sample, you'll see a rolling 6-month correlation. When the market's been down over a rolling 6-month period, we have a low correlation, positive returns. What you've given up is not much. Pretty tight correlation in the up 6-month periods. Give up a little bit, but clearly that at least over this period has been pretty good. And then to really kind of crystallize this, you look at these semi-annual returns and correlations in the bottom chart. We've offered a very, very tight correlation to equities when the market's been going up, like 2019. Net, you're looking at nearly the same performance. But obviously, you can get that from SPY or IVV or other very inexpensive ETPs with an even tighter correlation of nearly 1. But to be able to provide that and also give a heavy negative correlation when you want it is something that's truly unique, right? And this is not just a relative return that's less or eking out, maybe a 0 to 3% gain. This is significant positive absolute return that we provided. And when the market flipped back to a massive rally coming out of that, we again had a tight correlation. We got 14 out of 22 in the second half of last year. I'm pretty happy with that. And then this year, a very tight correlation and tight return. Most people, need to buy several different products to figure this out. And at ABR, we're offering a very unique return stream in our strategies that historically has given that dynamic correlation that we believe can be quite powerful in a portfolio. In terms of the actual fact sheet, I'll leave this up for a second and then we can get into questions, but you're looking at something that historically has had excellent returns net, very low drawdowns with around the same standard deviation as equities, with double the domestic Sharpe and nearly triple the Sortino. And you notice the convexity of the Sortino being nearly double the Sharpe. So that's about it for what we wanted to show. There's some disclosures here. We can answer some questions going forward. Let me know how you'd like to handle that, Vince, Michelle, and Ashley.
Yeah, thank you for that, Taylor. We've got a couple questions coming in. Everyone, again, the Q&A button at the bottom, feel free to type in your questions there and I will read them off to Taylor. First question here is, which you mentioned, someone asked about high frequency trading algorithms and how does that affect volatility and maybe your strategy?
Yeah, volatility trends are very quick and short in duration. They last days, maybe a few weeks. When you look at typical trend following strategies or managed future strategies, those trends develop over, months, quarters, and years, really. And so, we trade once daily to replicate the Wilshire Index. We think that having these strategies in ETPs, like ETFs or ETNs, particularly ETFs, well, I guess both of them is suboptimal. Most of them trade market on close or may have to trade market on close. The whole world knows that, including high frequency trading algorithms. So we offer these in different structures. We can talk about that separately. But I think that if you have to trade market on close, high frequency trading algorithms know that. They know what your prospectus says, and you could have some issues. So we don't do that. In terms of volatility, nothing's really different, right? A lot of people assumed that we could never see a VIX of 80 again like we saw in 2008. Here we were 12 years later and the same thing happened. I think that people mistakenly assume that, oh, this time is different, right? That's why we called it this, right? They'll say, oh, well, it was a global pandemic. Nobody could have predicted that. Oh, well, it was a global financial crisis. Nobody could have predicted that. 10 years prior to that. Oh, well, it was a Russian ruble crisis and long-term capital management's failure. No one could have predicted that. 10 years prior to that. Oh, well, it was, October 87. No one could have predicted that crash. No one can ever predict these major crashes, yet they happen with regularity over time, right? We have that slide right here. So I don't think that high frequency trading algorithms have any effect on changing what volatility looks like. I don't think if more and more people are using autocorrelation, it will change the outcome. All of this goes back to human behavior, euphoria, and panic. There's still humans behind all these algorithms. There's still humans that override a lot of them. And I think this causes autocorrelation to be around long after I'm gone. Good question, though.
All right, next question. How do volatility strategies perform if the market trades sideways for an extended period of time?
Yeah, that's a great question. So it really depends on how volatility trades, right? The market could be flat for a year. In 2015, I think the market was relatively flat. It was maybe up 1%. There were some moves during the year, but the market was fairly flat. Vol was fairly flat. It had some ups and downs, but VIX futures decayed, I don't know, 30, 40, 50% or more. So, if the market's flat for the next year and volatility sits at 20 for the next year, you're going to have a massive decay. Now, that doesn't really happen. The market might start at point A and end up at point A at the end of the year, but it's so path dependent. It's a really good question. It's really path dependent on how volatility moves over time. But if the market's flat, volatility could be flat or even down massively. Now, if volatility trades back and forth and does not find a trend, then that can be a little bit troublesome for a trend following strategy. That's why, some of our most challenging years were 2015, 2018 is the only year historically where our model had negative performance. You had, a couple moves where vol went to 30, did not follow through. It happened in February, October, and December. That's where you can run into a little bit more difficulty.
Is your analysis dependent on term structure of volatility? Is that important, or what term structure do you use?
Yeah, term structure is something that we look at, absolutely. It's one of the components that goes into our algorithms in the inputs. I think a lot of people, without giving away too much, I think a lot of people look at the term structure of VIX futures the same way they might look at other commodity futures. And VIX futures behave a lot differently than your typical commodity futures in terms of the term structure. I also think people make a lot of mistakes by looking at the VIX index. You'll see a lot of strategies that say, if VIX 20, then do X. If VIX 25, then do Y. If VIX 30, then do Z. Those strategies that look at stagnant levels of the VIX have not done quite well.
Will the size of ABR or other similar funds impact the index movement?
Yeah, I think that ultimately, we probably can't run $100 billion in this strategy. It's probably far short of that. I don't want to get into what we believe our capacity is on this call. But, we use VIX futures, which are the most liquid volatility futures in the world. It's the most developed volatility market in the world. The beauty of it is these markets are growing around us. You look at the V stocks, which is in Europe based on the Euro Stocks 50. There's an oil and gold VIX or VIX futures, I think, that trade a lot less frequently. I think somebody's coming up with a Bitcoin VIX, I heard. These will continue to grow. These markets will continue to grow. But yes, absolutely, you have to be mindful of what your market what your market size is and how you impact the markets. That's something that we are very focused on. And when you look at some of the best quantitative firms in the world, they're very focused on market impact. So absolutely.
What are the exact names of the Wilshire indexes for your long and short vol indexes? And can they be looked up on Bloomberg or other various data providers?
Yes, I'll give you the names, and what might be even easier is the tickers. The name of the long is the ABR Dynamic Blend Equity and Volatility Index. Ticker ABR VXX, Alpha Bravo Romeo Victor X-Ray X-Ray. And the short is the ABR Enhanced Short Volatility Index, ticker ABR XIV, Alpha Bravo Romeo X-Ray India Victor. And yes, they are on Bloomberg. The data from Wilshire, I think there's daily data going back to 2006.
Can you explain a little bit about those indexes? And you said in sample data, out of sample, right? The return structure of the index versus live running of the strategy. Can you explain how the sort of index prior to the real launch of the fund, how that was implemented, or how the return, like how similar are those compared to real results?
Right. So in 2015, when we struck the relationship with Wilshire, what we did is we actually just gave them our algos, right, under lock and key, as I mentioned. And so Wilshire has the algorithm, and every day they calculate the algorithm for each one of these indexes, which are independent. They are not inverses. They are completely independent indexes, the ABR long and short. They put that value on a daily basis on Bloomberg. But investors cannot invest in a index directly, and we don't disclose the algorithm, obviously. So we create investment vehicles so that investors can access those returns, right? So 2015 is when the long vol index went live. 2017 is when the short vol index went live. So to have that 75-25 combination of the two, you could not have that before 2017 in terms of live data. So everything before that is hypothetically calculated by Wilshire. Some people say, okay, great, I don't look at back tests. That's perfectly fine. I think the outsample data is compelling. But if you have a strategy that tracks the index with a 0.99 correlation over 4 years of live data, we believe that in-sample data should at least inform that decision. But look, our AUM did not increase dramatically until after we had that one outsample event of 2020, even though we had an in-sample event in 2008, 2010 with the flash crash, 2011 with the US debt downgrade. People need to see it to believe it, and I totally understand and respect that. Is that helpful, Vince?
Yes. Someone asked, what is your view on diversifying the source of volatility? You've mentioned the VIX and basically on the S&P. What about trading vol of gold or emerging markets or foreign markets in general?
So obviously ABR is working on a lot in-house, new strategies, new markets, improving our strategies if and when we do see something different. And by the way, we have never changed our strategies or our indexes. We haven't tweaked them. You're getting the same thing now that you got 2015 and 2017 respectively. But yeah, we are doing constant research and development. You can bet that we've looked at volatility on everything mentioned in this and in this question and more. But I don't want to comment too much on what we found so far until we decide to commercialize it. The question's on the right track.
Can you talk about, typically these type of strategies are found in, hedge funds. Can you talk about the structure of yours and why you chose the mutual fund versus running a hedge fund?
We wanted to provide liquidity and transparency. Within our strategies, we are using the most liquid equity futures, VIX future, vol futures, and US treasuries, right? So we wanted to match the liquidity of the underlying instrument to the liquidity that we provide our clients. And I think that's something that we've done a wonderful job of, and also giving the transparency right, of the vehicles we use, and also giving the corporate governance, right, of a SEC registered vehicle. So that's most of the reason why. We don't need to create artificial illiquidity just so that we can lock your money up.
Question here, when alpha autocorrelation characteristics present, it says visible to all in parentheses here, doesn't widespread recognition create arbitrage volume that eliminates the alpha? So basically, if everyone can see the alpha,
yeah, I get it. We get this
that...
question all the time. Isn't this obvious to everyone? I mean, was it obvious to short volatility on November 5th, 2020? I'm a trader. Traders have pretty big egos. Vol traders have the biggest egos I've ever seen. I probably didn't want to short volatility in November, but our model went pretty heavy short vol as the market started coming in. There's a lot of reasons. And look, we're not the only people out there that understand autocorrelation. We're not the only smart people out there. We don't have the world's best strategy. There's a lot of smart people with good strategies. We're the only ones doing it, I believe, the way we are in terms of how we offer it. But, you know, autocorrelation, you'd have to have everybody sitting there not doing anything, not responding to the news, not responding to their gut, not responding to what their buddies are telling them. I mean, you know, I can't tell you the texts I've been getting over the last 5 days about some of these large companies in China that people are worried might go bankrupt. Hey, this is a vol thing. Is your model getting set up for this, right? That doesn't even enter the equation of what we're doing. You know, what kind of news cycles running out of China. So yeah, you'd have to have every human being decide that they're going to be rational creatures all of a sudden. Just doesn't happen. What you might see is more and more people doing it, and maybe there'll be more products, and that's great for clients to have a wider selection. I like this next question, Vince.
Yeah, I was going to say, why? I know you have 100% basically the equity blend, and then you have 75-25. I think you also introduced a 50-50. So why those levels?
It's a great question. So 75-25 mix historically has pushed the returns furthest out on the efficient frontier curve. So we believe they provide historically at least the best risk-adjusted rate of return. Is the number really 76-24 or 72-28? Maybe, but pattern matching, that's a great way to put it. We like to say 75-25 is nice round numbers and good enough for government work.
Can you talk about how you would utilize this fund in a portfolio or more of an asset allocation structure, how it fits? And, you know, I don't know if I saw a slide on it in particular, but really what it's investing in and how, I mean, it's not really 100% long vol. So can you explain the dynamic trend?
Sure. So when you look at this slide right here, this is, you know, there's a lot of complicated inputs in our strategy, but the outputs are very, very simple. There's only 4 things that we're using the strategies. Long short VIX futures. It's literally the index that VXX tracks, long short. We don't use any options, swaps, or any of those other vehicles. It's just long short VIX futures, the most liquid futures in the world for volatility. Long only S&P 500. We're replicating SPY by using the futures, the most liquid equity futures in the world. And that equity hedges the long volatility exposure, right? Because of that heavy negative correlation that we showed you in the beginning. We also use long only US Treasuries. Here we replicate a 20+ year Treasuries index, a very well-known ETP, by using the physical Treasuries and cash. So portfolio consists of either a net long or short VIX futures position, a net long S&P position, a net long US Treasury position in cash. That's why we have the liquidity to continue to grow our business. We don't use any notional leverage whatsoever. I think we codify that in our documents. So it's relatively simple on the portfolio side. What's happening on a daily basis is the algorithm is dynamically shifting that volatility exposure. That's why you see this is the 100% long vol. You see how dynamic this correlation is. This is on a monthly basis, by the way. If I showed you daily, it's all over the place. And then on, when you put the little bit of short vol in, it kind of dampens those false positives from the long vol. But on a daily basis, it's trying to replicate those underlying Wilshire indices by moving back and forth out of vol, and then by using just the equity and fixed income and cash as a hedge against that. So that's what's going on inside the strategy. It is a very, very simple output, but the input's a little bit more complicated. Obviously, we've got over 20 sub algorithms that are running inside on a daily basis.
There's been a lot of articles out there in our world, 60-40's dead. With treasuries being where they're at, they may not provide the same level of buffer to a traditional equity fixed income mix. So I'll leave it with, why volatility, right? Versus why change do you believe the mold is dead? And if so, why does your strategy fit a solution?
I have no idea if it's alive or dead. Equities go up over time. One thing I'm willing to bet, I'm going to make this bet because I'll be dead. 100 years from now, the S&P will be higher than it is today. I mean, stocks go up, right? They might go flat for 30 years. It might be Japan, but over the long term, stocks go up, right? Wealth is created. I'll be dead by then. So if I'm wrong, then, come find me. But interest rates are also historically at all-time lows. They could go lower, right? People didn't think they could go real negative yields in Europe. Here we are. You pay money to put you pay interest to put your money in a bank account in Switzerland, right? Oil went negative. So who knows? Here's what I do know. Volatility is a derivative of equity prices, and, in any real major move, will have a major negative correlation to equities. That's a fact. I know that over the past 40 years, fixed income and equities have moved moving in the same direction. It's been great. Will that eventually turn around? I have no idea. I don't know that 60-40 is dead any more than the next guy. I believe that you need true diversification, not superficial diversification at the margins, not saying, oh, I'm going to substitute my fixed income for private equity. Guess what? You've got levered public equity. You're not getting a hedge to your equity by moving to private equity or moving to private debt. Guess what? You've got levered debt. In fact, it's probably closer to equity than debt, but that's a whole nother discussion. So I believe, or we believe, that volatility must be used in a portfolio if you're looking for something that will continue to get you that negative correlation when you want it. You just need to use it in a dynamic fashion, or you will experience that historical bleed out or blowout. And I think it's really important to understand those correlations, and they may be changing for certain asset classes, but not for volatility, at least not in our view.
Okay. Anyone that has any last questions, please type them in now. I'll give a short little close. Once again, we have our auto show lunch, which will be September 29th. It's in person at the Chanel Hotel. Please check your email as we've sent out the invites for that, and we'll probably be sending out more. Be sure to sign up. Be great to see people in person again. On October 6th, we'll have another webinar. That's Black Creek with commercial real estate update. And then our annual forecast lunch will be November 5th at the Motor City Hotel. And that also will be in person. So please be on the lookout for invites for that. Taylor, really appreciate the insight into volatility. Appreciate your time. Thank you for delivering this for us. Very interesting. I think it's a great way to potentially hedge out your portfolio or provide more protection in severe bear markets, right? And something that shows stronger negative correlation when things are going wrong versus increased correlation, right? As we saw. So something to think about. Once again, thanks, Taylor. If no one else has any questions, I will say goodbye and have a great rest of your day.
Take care, everyone.
All right.